combination. For example, our accounting fees we charge to help with the business combination, or definitely legal attorney fees dealing with the mergers or acquisitions or consolidations. Here's some fees we incur to probably get those fair value amounts. And the general rule is to deduct them right away. Yeah, you don't capitalize them as an asset, but here record it at the time of the consolidation, the combination. Also, if any costs you incur internally within the companies to manage to facilitate the combination, you just treat them as normal operating expenses. Again, just deduct them right away. The only cost that we possibly need to treat differently, and this is the way we also do it when you have stock or securities being issued, even outside of a combination, is just to reduce the paid-in capital if it's a stock that you're issuing. Yeah? Here, debiting the paid-in capital account. So here's some dollar amount examples. So costs incurred for those accountants and attorney fees deducted right away. Professional service expenses. Here, costs incurred internally within our parent or subsidiary companies. We treat them as current operating expenses, yeah, deduct them. The only exception again is with costs for the issuance of stock, and that amount is debited to the additional paid in the capital, yeah, reducing that account. So our next topic is now to journalize or record the acquisition of the subsidiary. And in our case here, for this part of the chapter, we're not going to dissolve or liquidate the subsidiary. We're going to continue holding it as a sub. What we're doing here is getting information to eventually prepare a worksheet that will help us with the consolidated financial statement. And our parent company, the acquiring company, is not buying the assets and liabilities of the subsidiary like we had seen in the case of a merger. But what we're acquiring, the parent is acquiring, is a stock investment in the subsidiary, 100% of the stock, at least for this chapter. And we're not going to dissolve the subsidiary. It's going to be kept as an ongoing business, an ongoing company. And again, we're going to prepare a worksheet to combine the parent and the sub to prepare a consolidated financial report. So let's return to our example of big and small. And they're going to be doing this combination again at the end of the year. So convenient to do things at the end of the year. And we only are issuing stock here, 26,000 shares, $10 par, so $90 of paid-in capital per share. We're incurring 40,000 of professional fees. In addition to the stock, we're also told that there's going to be a contingency fee paid by Big to the owners of Small if in the future, probably the next year, the small subsidiary has earnings of $300,000. And if that's the case, we're going to pay those prior owners $83,200. And based upon their estimation, based upon the present value of what they're going to pay, we come down to an amount of $20,000 and not this $83,200. They don't show us how they got this amount, so we'll just take this amount. And this is the amount in addition to the stock we have to pay to acquire the sub. So here's the total value of the stock we're issuing out. Here's a probable amount we're going to be paying, again, assuming that we hit this target for the sub. So this is the total cost of buying the sub. Notice this 20,000 is going to show up as a liability on the books of the parent. And also the books of the parent, we're going to be issuing out stock. So these two accounts or these two groups of accounts will be changing, increasing, in addition to the investment account in the sub for this total amount here. So if we to journalize everything here, and this is only on the records of the parent, on the records of big, we're buying an investment, debiting asset for the total costs, of which it includes the 20,000 of probable liability we have to pay in the future to the prior owners of the sub. And of course, the issuance here of the stock itself. There's some scribbling here. I don't know what this is here. And also the $40,000 cost we deduct right away. So now let's take a look at how we prepare that consolidation worksheet to eventually prepare a consolidated financial report. Well, again, we're assuming we're not going to dissolve the sub like we had done earlier in this chapter. So we're given the worksheet itself. We have a column for each company. Here's the parent. Here is the sub. And then adjustments to the accounts in the two columns to the left, adding and subtracting across to get the totals that we're going to see on the consolidated financial statements. I believe, as mentioned before, we have just a debit and credit here for the adjustments or eliminations, but in the other columns, this column here and here, we're showing debits as positive numbers and we're showing credits as negative numbers. This is not negative revenue. This is really a positive revenue when you see this negative amount. Credit, debit, net credit balance. Notice that we don't show revenue and expenses for the sub because that took place prior to the consolidation. But for future years, because they're still in existence, we're going to show revenue and expenses for both companies. But again, at the time you consolidate, the time you acquire the sub, you don't include the revenue and expenses of the sub. So in other words, only the revenue expenses of the parent are reported on the consolidated financial statements at the time of the initial acquisition. Even the retained earnings statement, you're only including retained earnings, dividends, and the balance of the retained earnings of the parent on the consolidated financial statements. Different though for assets. So here we see the beginning of the assets, book value of the assets on the sub. Notice this is the amount we just had recorded when we bought the sub. Let's continue on the next page. So additional assets, both parent and sub. And then again, this is all book value, including liabilities at book value, including this new liability that we had just journalized, including the additional stock in here that was issued and additional paid-in capital. And we've seen this retained earnings in the previous page. Again, this is all at book value, this first two columns. But then we're going to be combining these two companies together. And we got to eliminate through journal entries, or at least in these two columns, to ultimately get the amounts that need to be reported on the consolidated financial statement. Keeping in mind, whatever you're putting in these two columns are not journalized and posted in the accounts of the parent and sub. You only are doing it here on this worksheet to ultimately get the balances you report on the consolidated financial statement. And as you can see here, the code letters here, either A or S, The S stands for eliminating the equity of the sub. You notice all of these two match up here, So ultimately, what you're showing here as a consolidated equity accounts, is only the parent. So the offset to these debits is going to be reducing the investment account. So let's go to the previous page again. This investment account. You're reducing it by the net book value of the sub. That still leaves this amount left to be eliminated. In other words, in this consolidated group, you cannot own an investment in yourself, so that has to be zeroed out. So that's done through the remainder here of adjustment letter A. A stands for allocation. What we really are doing is allocating the additional fair value we're paying to the assets of the sub. In other words, the computer and equipment was really worth $600,000. So that's $600,000 here plus the book value, not the fair value now, but the book value of Big's computer and equipment will be the total for the consolidated group. Likewise for other assets, including ones that had undervalue or zero value here. And of course, the ones costs we cannot allocate to specific assets goes into that goodwill asset that shows up on the consolidated financial statement. Not on the books of Big. You're not journalizing this 70,000 here in Big's asset. Yeah. Of course, it's not going to be here, but it's only going to show up on the consolidated financial statement, including an adjustment to fair value of the liabilities of the sub. So again, combining all the A's together here results in the remainder of the investment being closed out or zeroed out on the consolidated financial statement. So let's take a look at the journal entries. And again, well, this is the calculation we saw even way back at the beginning of the chapter, allocating the fair values to the assets and liabilities of the sub, and then whatever we cannot allocate to goes into goodwill, or if the excess book value here was larger than the proceeds we gave to acquire the sub, then we would have a purchase gain, yeah, a gain to be recognized. But in our case, we have goodwill, which again only shows up on the consolidated financial statement. Let's take a look at the journal entries. So the first one, again, eliminating the equity of the sub. I guess that's why they call this entry S. We zero out the positive equity accounts in the sub, and the offsetting debit is to reduce the investment the parent has in the sub. And entry A, allocating the fair value to the assets of the sub, including goodwill, including liabilities of the sub, results in a net of zeroing out the remainder amount in the investment account for the sub on the parent's records. Again, this is not posted on the parent, yeah, or the sub, but only used for consolidation of the financial report. Let's move on to the next topic. So, in addition to um, goodwill asset, we try to identify as much as possible other intangible assets and allocate its fair value amount. So our textbook gives us some examples of intangibles here grouped by marketing related or customer related. I'll just go quickly through this. You can take a look at more detail in our textbook. These are probably copyrightable assets and those related to contracts. In fact, at the beginning of this group of slides, they tell you intangibles can be probably identified either by contract or if you can separately sell it from as compared to the rest of the company. Let's take a look at that rule here. Yeah, intangibles created by contract or some legal right, or intangibles that you can separate it from the rest of the company and in fact sell it without selling the whole company. If that's the case, you gotta be able to set up that intangible asset at the time you do the consolidation. And only if there's excess value that you cannot assign to an intangible, then you have that goodwill asset. Let me point out a couple here. This non-compete agreement, probably you're going to be hiring your employees under some type of, let's see, employment contract here. And maybe one of the provisions is if you leave the company, you're not allowed to take any of our customers with you. That's a so-called non-compete agreement. And in the past few years, non-compete agreements are kind of held to be unenforceable, legally unenforceable. There may be some exceptions in the case of high executives in your company that leave, but the thinking is you cannot force a person not to be able to uh, keep a livelihood. So a lot of these non-compete agreements are unenforceable. Just because you know who your customers are, this customer list, and what you sell to them, probably the key is not the list itself, but the salesperson, the contact in your company with the customer. Yeah, they have a relationship going, not just with the company, but with that person. And it's hard to keep that kind of asset. So I'm not sure what kind of value you can assign to it. Let's move on to the next topic. Oh, this one here talks about, if I can get it back, if there's goodwill on the records of the subsidiary, you kind of just ignore it and just look at the new goodwill for the whole consolidated group. Let me go back to that trial balance and kind of point out where goodwill would show up if you had it in a subsidiary. Okay, again, here is the parent and the sub, and eventually we have a goodwill for the consolidated group. But if you bought a sub that it itself had a goodwill asset, we're told to pretty much just ignore it and look at the new goodwill in combination of the parent and sub together to determine what the value should be over here. So in a way, if you do have an amount here, it's probably going to be eliminated and only bringing it up or down to whatever value it should be after the combination is done. I think the last slide I want to cover is just talking about again international standards, you know. And the thing here is it's pretty much the same as U.S. GAAP. You know, so we don't have to be concerned about this. I believe, as I mentioned at the beginning of this chapter, we're going to ignore the appendices at the end of chapter 2, which talks about old rules for combinations of or consolidations of companies, something called a purchase method or pooling method. Older companies may be grandfathered in under these provisions here and not using the acquired method or the fair value method, yeah? But just be aware that these are other methods that are still used by older companies. Okay, that's it for chapter 2. I'll talk to you again in chapter 3.